Welcome to Real Estate Pro Tips and Strategies. The theme is how to buy a home or sell a home in a changing real estate market. Hi, my name is Pete Sabine, and I'm here with my team partner, Leslie Whitney. We are real estate professionals with Compass and the 5-star real estate team here in the San Francisco Bay Area. We want to share with you our real estate expertise to give you a competitive edge and provide insight with useful information so you can make an informed decision for your next home purchase. Leslie and I break down the most important aspects of real estate. Future podcasts will reveal how to navigate as a home buyer or seller. Let's begin our podcast.
Welcome to our second podcast. This one is called Finding the Money, How to Qualify for a Home Loan. Today we have our guest, Bob Casper. Bob is a senior loan officer with Cross Country Mortgage, and Bob has been in the business for 36 years. He's very knowledgeable about home loans, and he's wonderful to work with. It's very important to have a great working relationship with your lender. It becomes quite the personal relationship, actually, as you go through your transaction. Buying a home is not as simple as finding a home for sale, making an offer, and then handing over a large amount of money. Lots of things go into getting the correct loan for you and using it for your purchase. Most of us will need to obtain a loan to make a home purchase, and even if you have done something like that before, even if you've bought a home before, the home loan process can be complicated and confusing, and over the years, lots has changed. Today, we will provide expert advice and tips so that you will know what to expect when you apply for your home loan. So, Bob, let's start with the very first question. And this is something that we get asked a lot. What is the difference between a home loan and a mortgage?
First of all, thanks for having me together with you guys today. There actually really isn't a difference technically between a home loan and a mortgage. But a home loan is more of a marketing term to help people understand that they're borrowing money secured by a home. Mortgage is the technical name for the financial instrument.
Okay, interesting. Good to know. And so what is the difference between a loan pre-qualification and a loan pre-approval? We see those words often when we're shopping around for loans on the internet. And there is a difference between the two, pre-qualification or pre-approval. Can you explain that a little bit?
Yeah, you bet. Actually, there's a significant difference between the two. So to start with, and it really does go in that order, a pre-qualification is, although some people can have different definitions of this, but I would say the industry, probably 80 or 90% would agree with this, that a pre-qualification is an initial evaluation that people get to figure out what they qualify for in terms of trying to borrow money to buy their first place or buy a home or a condominium. When they're qualified initially, it could just be a phone call. It could be an email, and it could be real brief. So pre-qualification could be as simple as having a 1-minute conversation or email interchange with someone. Somebody crunches some numbers for them, gets back to them and says, you can afford to do this. And or it could go all the way to actually significant number of steps of actually a more lengthy discussion of their whole financial situation, evaluating and looking at their credit history, looking at their income documentation, and so we'll get into a little bit more what documentation is needed, and then actually issuing an opinion on where they stand based on that. So as you can see, there's quite a wide range there. And when somebody gets a letter, it can make it really challenging to understand how valuable that really is.
So when you're looking at a pre-qualification letter, are there some telltale things in that letter that might help somebody understand if it's really just a pre-qualification in disguise?
Yeah, good question, Pete. A few. Some of them can fool you, and they'll make it look like they really are a full pre-approval letter. And by the way, just to get to that, a full pre-approval should be, but isn't always, should be the steps that borrowers will go through to have their employment, their credit, their income, their any kind of debt repayment, title history related to anything basically about them financially reviewed analyzed and calculated so as to figure out what they qualify for. And it's more than just one person's opinion, such as myself, but it's actually coming from an underwriting committee or an underwriting person who actually has that professional duty for a bank or an institution. And then it's just something a little more that you can count on. So back to your question, Pete, about anything's telltale on a pre-qualification letter to tell you what it is. Number one is the word pre-qualification used to begin with. The other one then mainly would be what we'd call the conditions or the subject tos. They'll oftentimes word it as subject tos. So what does that mean? You're pre-qualified to purchase a $300,000 home, putting 10% down for the down payment, but it's subject to, and then if you see about 6 or 8 or 10 or more items listed there, probably means there's not a lot of evaluation that's gone on there yet.
Yeah. So I think when I talk to my clients about the difference, it's a pre-qualification is a loan officer's opinion, whereas a pre-approval is an underwriter that's confirmed and verified the information that goes through the loan approval process. Is that kind of a simplistic way of helping them understand that?
I do.
Yeah.
The only thing that might be important to point out here is that even though it's worded a pre-approval, doesn't mean it is a pre-approval.
Right. And that's the thing. We're seeing that misused. It's like Kleenex and tissue, and it's gotten that bad. It's like, do you really know? And we've had a lot of clients come to us thinking they're all buttoned down, dialed in, ready to go. And we discover that they're so far from that they have to actually kind of start over and go through the whole process of being verified and confirmed.
Yes. And well, how many of us have had solicitations in the mail for a credit card and it says pre-approved on it?
Yeah.
A lot of this comes from the marketing that comes from just trying to help people think, hey, you're almost done. Mm-hmm. You don't want people to think that there's work involved to get something,
right?
Or that we already love you,
Yeah.
And so the lending industry's adapted to that. For a lot of companies, your banks are a little more conservative on the whole, so they'll be careful with that language. But there are a lot of mortgage brokers, mortgage bankers, credit unions. They'll often still use the term pre-approval, but it really doesn't mean that the file has been fully looked at by the right people. Mm-hmm. And have to your point, to have something that you can really count on.
Does a bona fide pre-approval letter have an expiration date on it? It says you're pre-approved up till June 1st, 2021. And, is that a clue that you're really up there with the pre-approval?
Yes, that's another good point. A pre-qualification will usually not list an expiration date.
Yeah.
But a pre-approval that's more bona fide should state something. This commitment is good until a certain date, or it may even say things like the documents that have been reviewed will expire on a certain date, and then they need to be re-reviewed again.
Okay.
For example. Mm-hmm. So that does give you, just a little more of an indication that it's something that is more significant, that you can go to the bank on.
Right.
The whole term.
Okay. Well, we do know that this pre-approval letter is a very important part of anyone's offer on a property. And so it's really important to understand what you have in your hands when you think you're ready to go to purchase a home. So what, Bob, are some of the common reasons for being denied a loan, besides obviously perhaps not having enough money, but there must be other reasons as well. Can you explain that?
I would say probably the main ones, if we had to kind of look at, say, the top 5 statistically, would be insufficient income. Would be one. So what does that really mean? Without getting super technical here, generally speaking, lenders, when they're evaluating what you can afford, if you're a salaried person, we'll keep it simple now to begin with, they want to make sure that, generally speaking, all your payments that you have on a monthly basis for the mortgage, and including auto loan payments, student loans, credit cards, anything of that nature, it's not more than 45% of your gross income on a monthly basis. So in areas like ours where incomes are solid, but prices are even more solid, it's not unusual to see people try to go to 50, 55, 60% of their income. And so that knocks them out.
So is that rule that you're explaining is that industry wide, or could there be could they find a loan from some lender elsewhere that bends that rule?
Yeah, gosh, that's an interesting question, because it is after the financial crisis, more or less started to resolve itself in 2011-12. A fairly large piece of legislation from two senators, so nationwide then is where this comes from, Christopher Dodd and Barney Frank, passed the Dodd-Frank legislation. Right. It's about 1,800 pages.
I've read it, all of it. It's fascinating.
And it, as usual, there were a lot of problems in the lending industry, and it was determined that, more or less there was a new sheriff in town. And those rules were put in place, and it's fairly strict. I mean, that 45% number is pretty hard and fast across the country, to answer that question.
Yeah.
It varies in several different categories. There's a category of loan called FHA financing, where you're allowed to go pretty much to 50%, for example. A little more latitude there. On the other spectrum, or if you get a jumbo loan, which in our area is anything generally over $765,000, you've got to keep it at less than 43%, and that's pretty hard and fast. So if you're trying to deviate or go above those numbers, then you're pretty much going into a category of really what we'd call private lenders. Right. Those are not necessarily hard money lenders, if you've heard that term, but generally you're going to probably need a larger down payment. You're going to pay more in interest rate. And what do I mean by more? Probably at least 1.5%, 2% or more higher. So it really behooves you to try to stay in that, kind of less than 50 category.
Okay. Yeah. And what were some of the other things that could possibly have somebody not qualify for a loan?
I would say next on the list then would be credit related. And that could be, it could be an insufficient credit score. And people are becoming more and more comfortable with what credit scoring has really only been around strongly now for about the last 12, 13 years. And before that, lenders just looked at a report, and if it just looked like everything was paid as agreed, you're fine.
Interesting.
Then scoring started to become to try to get a little more of an analytical approach to evaluating people, be able to use software systems to tell people whether they're approved or not. And so generally speaking, everybody's kind of used to it. The highest that you can get with these scoring programs is an 850. I've never seen an 850, by the way, so I don't really know what it takes to get there. But I do see some 815s, 820s from time to time. But anything over 720 or so is still excellent. And so I would say either not being able to get to those minimum credit scores is number one, or number two, people not having enough credit, insufficient sources of credit. What does that mean? If you have a 805 score, from Credit Karma, you think you're golden. It may not necessarily be the case if you've just got one credit card that you've paid on time for 10 years, but that's all you have. Generally speaking, you want to have at least 3 to 4 different sources of credit that you've had for a couple years or more. So if you have the combination of that and credit scores that are over 720 or 740, you're really in good shape.
Okay.
And then I would say maybe the only other category that's more common for loans to be declined, it would be people that have made really different changes in employment. Let's say you were a salaried employee you worked for Oracle, and then suddenly you moved over to work for Salesforce, and you're on 100% commission now, and you've only been doing that for 6 months. There's a different measure. You've got to have a longer period of time to earn things like bonuses and commissions before they can be used. And so with a lot of entrepreneurial and different kinds of income that are typical with our economy in the Bay Area, it's really important that people have their sources of income, properly analyzed, make sure that it meets the litmus test.
Okay, that's interesting. Good information. What can an applicant do to increase their chances of being approved?
Number one, I would say prepare ahead of time. So get connected with a good professional that will give them some good advice on how to start. Lay out generally what is looked at. Have their credit reviewed, not just from an online source, but actually have the actual 3 credit bureau, what we call a tri-merge report looked at. And actually don't just rely on using mortgage calculators online or what have you, but actually have a lending company really evaluate, see their tax returns, see their pay stubs, see their W-2s, evaluate how long they've been with that employer, or if they've been self-employed and been on their own, let's say, have the history of their income evaluated so that they get the opinion that comes back and says, yes, you've got this amount of income that can be used. Now you have something measurable to work on. But if you just plug in on a mortgage calculator that you make $10,000 a month because you're doing, $11,000 a month in commissions, it may not be the $10,000 a month that a lender really uses.
Right, because a lot of people that are self-employed business owners take advantage of tax deductions. Why wouldn't you? They're there for a reason, to reduce your taxable income. And so tax returns are very important if you're self-employed, right? You have to actually add back in things like depreciation and things of that nature to get to your true income.
Yeah, good point, Pete. And they'll use other deductions such as home office, especially this day and age now with more people working remotely, with what's gone on during the pandemic. You've got more people that are going to use a home office deduction, which they're allowed to do, but lenders deduct that now from the income that's being used. So that kind of category. And it also could be for people like police officers, firemen, nurses, people that have uniforms. They'll deduct the expense of their uniforms or their work-related attire. And that can have a significant impact on the income that's used as well. So you don't want to just, bottom line, you want to have a professional evaluate it.
Right. So I think, correct me if I'm wrong, but one of the challenges you might have is that people, when they start shopping for a loan, they typically will shop online, and they're driven by getting the best interest rate, right? Who wouldn't? And so what I've learned about that is that it's really what the bank is not telling you about what the interest rate really is, right? There's a lot to the interest rate that you're going to get as a specific borrower based on a lot of factors that you've just touched upon. Credit score would be one of them, down payment amount, the loan type, the loan amount. Don't all of those things actually factor into the rate you actually get as opposed to the advertised rate?
Indeed. They really, on average, there are about 8 or 9 different factors that all influence what the ultimate interest rate is going to be that somebody obtains. You hit on some of the important ones, Pete. So size of down payment, credit score, type of loan itself. Sometimes people they'll see, wow, I just saw a 1.99% interest rate, advertised. Are they really that low? Well, did you know, was it a 15-year? Was it a 30-year? Was it an adjustable rate mortgage? I mean, well, I don't really know. I just know, what I saw. The other component that's often misplayed, because lenders, they know how to try to market, and their whole goal really is to try to get people to either email them or call them. They're trying to draw the business in, right? And so they understand that people don't always know what points are, which is essentially the kind of price tag of the interest rate. An example of that, if you pay 1 point to get a really good interest rate and you borrow $500,000, that's $5,000, 1% of $500,000 added on to your overall closing cost. Sure, that's going to get a better interest rate, but you don't really know what's involved with that sometimes when you're looking at a interest rate that's advertised.
So let's talk about points. So you just said that a point is actually 1% of the amount that you're borrowing. So you're borrowing $500,000. That's a $5,000 cost for that point. So I've seen loans advertised at a specific rate that say no points. But when you get the actual cost list, which they're required to do, right? Aren't there federal laws around disclosure about what the cost of the money is? At some point, the consumer sees that.
In fact, the way the disclosures laws have changed over time after the financial crisis is it used to be you had like a week to get disclosures like that to the borrower. Now it has to be to them within 48 hours of when they apply for a loan.
Okay. So the way this plays out is you take the bait, if you will. You see this great interest rate, no points. It's the best loan you could find shopping around. you fill out the application, and then 2 days later you get the cost, the disclosure that's required.
Right.
And what you see are about $4,500 in these really official sounding fees, like admin fee or window washing fee. I don't know, make something up. But coincidentally, you add up all of those little pieces of fees, and it's about a point. So I mean, is that to me just seems like packaging the money so that you draw them in, and then after they've applied, they see all of these costs and they sound official. And I've had clients not even question it, to actually put a calculator to it and figure out that those are what we call garbage fees, that it's just their way of packaging a point, but they're slicing it up into different sounding important pieces.
Yeah, that what you're describing, that document, by the way, is called, the industry calls it an LE. It stands for a loan estimate, and that's the official document required by federal law to get to borrowers. So it is good to get a loan estimate up front so you can really see how things are broken down. Generally, by the way, a good general rule when you're just starting from scratch is when you hear this term closing costs, what should you kind of be thinking about? It's a pretty good rule to say about 2% of your purchase price, unless you're putting, 50% down or something. But if you're going to buy a $500,000 home and put, 10% down, then on average, you're going to have about $10,000 in total closing costs. And that includes a lot of different categories. And but what it doesn't generally include is extra points. So to your point, if they're not really seeing the whole picture, and then that interest rate somebody's advertising really means you've got to pay 1 point to do that. Well, that $10,000 I just talked about just turned into $15,000.
Right.
You didn't budget for that.
Right.
And those are the nasty surprises people get sometimes.
Yeah. So then if you're really going to shop properly, you have to get to the point of that disclosure, that loan estimate. Is that what it is?
Right.
Okay, so then once you get that on the table, then you know what you really have. And then you go out and compare another loan or two using those to match to see how what the numbers really are, right?
You can do that. I think it also is helpful if you start to work with somebody that you really trust to begin with.
Yeah.
That works for a reputable company too.
Right.
Not to knock really small companies, because there's many good ones, but these days there are a lot of good social surveys and rating services like Yelp and others that can give you a good idea of what, where people are. You hear the name Bob Casper and you're like, well, I don't know anything about Bob except for what the realtor told me, let's say, or what my financial planner said. What else do I use to try to evaluate that? Well, there are other ways to look up what people are, but I still think it can be a pretty big waste of time, in all honesty, to start going on a big shopping spree and trying to compare 5 different lenders' closing costs.
Online especially, because you're not getting the full picture until you get to the application and that loan disclosure. That's really where, all the numbers come up, right?
Yeah.
So,
but if you go, if you've got pretty darn good ratings, let's say, and feedback on a person, either through your relatives or your financial, service people you're respecting, like your real estate agent, then go with that person to evaluate your situation best, and just be honest with you about what are normal costs. Because you're right, you use the term garbage fees.
Yeah.
Pete, but there are a lot of miscellaneous things that are just legitimate costs. It's legitimate to have processing done, to have underwriting done, to have an appraisal done, for example. And so there are a lot of those things. They generally add up to somewhere between $2,000 and $3,000 for most lenders. Yeah. It's when that number starts to get significantly more than that,
right?
Where
red flags. Yeah. Start paying attention to what those things ask. Just ask what they mean. Yeah. Ask if they can waive some of those fees, and they'll tell you, right? If they're there's that, but there's also points aren't necessarily a bad thing, right? I mean, there are times when paying points on the loan makes sense, like to quote buy down the interest rate. Can you tell folks what that means when you buy down the rate?
Well, to begin with, and on this one point, I don't want to claim to be a tax expert here, but I am married to a CPA, so I know a little bit about, and pay attention to this topic. But generally speaking, within the tax code, when you buy a home, when you do pay points, they are part of the deductible expenses that you have the year you buy the house. And, those other deductible expenses are generally the interest you pay and the property taxes you pay. But for one-time fees, points can be included in there. So translated, what does that mean? If you keep using a $500,000 house and people are going, well, where's that located? Not around here. But I'll still use, $500,000 house, 10% down, and you begin to evaluate, gee, I can get a 0.5% better interest rate if I pay 1 point. Let's do the analysis. A good loan officer should be able to help you do this analysis, give you an idea of how much is your payment going to go down and how much does it cost you up front to obtain that benefit. You can figure out, well, if I can earn that money back in maybe 4 or 5 years and I'm going to be in this place for a while, maybe it makes sense to do that. Number one,
right,
to your point. And then two, there's also that tax benefit I just referred to. And so if you're in a little bit higher tax bracket, the combination of those two, and assuming that you do have that money, because with a lot of protects, first-time home buyers or people just getting started, they don't always have the money up front, right?
Right.
But if you do, or you're getting a gift from relatives or something like that, it's worth evaluating to see if it makes sense. Can I add one other thing that just the other component we talked about, things that affect interest rates? The other one that's really big is just timing. And what does that mean? Well, even if you did go out and get estimates from 3 different lenders, let's say, and one was on a Monday and another one was on a Wednesday and another was on a Friday, you could have 3 completely different numbers, not necessarily because their rates are that different, but because the market's changed in between. Because rates do change like stock prices do.
Well, before we talk about locking the interest rate, which is, there are pros and cons to that. What I wanted to say about points and closing costs is that there is another source to help a buyer with those closing costs, and that's the seller. Sometimes, depending on market conditions, if it's not an overheated, white-hot seller's market, if it's more balanced or a buyer's market, it's very common for the buyer to ask for a credit from the seller to help cover their closing costs. And it's my understanding, correct me if I'm wrong on this, but most lenders across the board will allow up to 3% of the purchase price to be applied towards closing cost as a credit from the seller, as an example. Is that pretty much the case still?
That is generally, it can be even a little bit higher than that in some cases. Some government loans allow 6%, but 3 is a good number to use, 3%.
So let's illustrate a scenario. So $500,000 price, closing cost, credit maximum, say 3% of that's $15,000. And so you're looking at, without paying points on the loan, you're looking at like $7,000 for your closing cost. But if you pay that extra point, that's going to drop your rate down by a half. And if you're going to live in the house for 10 years, you're going to save a lot of money in interest. So going to the seller and asking for a credit for closing costs, that just means you don't have to bring your own money to the closing to finish the sale. You're getting it from the seller. It's a concession.
Yeah, that's a good point too. And the other thing that's interesting, we'll see if it changes with time, but the IRS even ruled several years ago that even though you do get a seller credit for those costs, if you pay points, you still get the deduction for them.
That's right. That is right. I forgot about that.
You're still paying for them, so that was tested in the courts. And again, it could change, but for right now, you can get a little bit of the best of both worlds.
I like that.
Well,
it's not very often you get that from the IRS, right?
No. That's a lot of good information, and it really proves that, you really need to have a lender that you trust and who knows all these little details and ins and outs and pros and cons and rules.
But that's super important because I think a lot of borrowers tend to shop for loans online thinking, why do I need a loan officer for to help me? And they just think they can do it all, and they're really missing out on a really great opportunity to have proper counsel and guidance for all the options, right?
Absolutely. I mean, there's so many things to think about, and unless you're getting professional information and good advice, you're losing out. So it's really the lender part of the home buying process is really important. We always emphasize that.
Can we talk about rate locks for a second?
You bet.
How those work?
You bet.
Because you just mentioned a minute ago that interest rates are a moving target, and as time progresses, rates go up, down, or go sideways. And so what's the advantage for locking in a loan rate as a buyer?
Well, start with that one to begin with. What's the advantage? I'd say when you're buying a home, I would say, particularly in this kind of market we're in now, where your average close of escrow is not long, right? There's not too many 45-day escrows that are being accepted, right?
30 on the average, yeah.
So if you take a 30-day window of time and you're qualified for a mortgage of, we'll use 500,000 again, example. And those lenders, they base it on a certain interest rate. They don't maybe necessarily use the exact best interest rate they can get that day, but they maybe add 0.5% to it because they can fluctuate. So you want to make sure you're not, kind of bumped out of the water if rates go up. Well, you've got this limited window of time to buy the house. One of the big advantages of locking as soon as you can, which is usually the day after you go into contract on the house, by the way. Most lenders allow you to do that, sometimes even the same day. Mm-hmm. Well, one of the advantages is knowing what you can get. I mean, if you can get a 2.875% interest rate, there's a pretty strong argument to be made to secure that. Even though, of course, one of the risks is people ask, well, what happens if it goes lower? And that's another little topic here. But it just knowing what you can get and not wondering, gee, on day 25, right at the end of the process, I decided to wait as long as I could, and now rates are 3.25. Not only is it, not super pleasant to have a payment that's higher than you thought, but it could affect your qualifications.
Right. You could actually be out of the market and not be able to get the money that you need to buy the house you're in contract to buy because you entered into a time of high volatility in the mortgage market, and it went from 3% to 3.5% in 3 weeks, and now what? And some people think, oh, well, that could never happen. Well, I think it's happened a couple of times this year, hasn't it?
It has.
I mean, this has been a very unusual, volatile year for all reasons, especially in the financial and mortgage markets. So,
and it wouldn't surprise me if we see, just because we've been, 36 years of doing this, seen a lot of cycles in interest rates, but this one's probably one of the more unusual. Of course, we've never had a pandemic like this, and that's been one of the major influences on interest rates coming down. But at some point, as most of us know, this too will get to a point where we have, vaccines, hopefully plural, or at least, people get healthier, whether that's 6 months or a year or 2 years, whatever. We don't know that. What we do know is that when that happens, the prospects for economic improvement will grow more, and interest rates are likely to move up from where they are. So, in other words, it could, when you're at historic lows like you are right now, it could make a lot of sense just to maybe, not get too greedy with what you think rates are going to do, even just from that standpoint, and take advantage of the time frame, and then maybe even sleep a little easier while you're in escrow, not wondering if, things are going to change day to day.
Is there a cost to lock in the rate, or what happens if the rate lock expires and you're still in escrow? What do you do?
Yeah, two different good questions. So to begin with, is there a cost to lock? Generally not if it's a 30-day timeline. That's considered a standard lock.
So it's free, essentially,
for 30 built
days.
Into the price, shall we say. And then it's when you go longer than that, when you do begin to pay a premium. How much? Well, to go to 45 days, it probably costs another 1/8 of a point on the point cost. So what does that translate to? On a $500,000, that's probably $500 or $600 to go longer, 45 days. To go to 60, it's double that. It's probably $1,000 or $1,200 then for that size loan.
To keep the rate locked
for that entire period of time.
Right.
Yeah. Because what the lender's basically saying is we're gonna guarantee that rate is still there. And there's a lot of technical things going on behind the scenes that secure that. They're basically going out and buying a commitment for that loan ahead of time. But also the second thing that I was alluding to is, or that you're getting to is, not only is it just, a cost associated with it, but you've got most lenders, not all, but most lenders have some kind of a float down capability. What does that mean? If you lock the interest rate in initially, and then by the time the loan's approved, which is usually about 1/2 to 2/3 of the way through the process, the general rule is if they're more than 1/8% better than where you were when you locked, they'll give you the benefit of that. Sometimes it needs to be negotiated. Sometimes it's automatic. There's some variation. But the main thing is it's one good thing to ask your loan professional to begin with. What is the lock strategy or rules for your organization?
Is there ever a reason to float and not lock in the interest rate after your offer has been accepted?
Can't think of too many of them.
Okay.
I think there have been a couple instances, but I have to go back a ways. The day that Iraq invaded Kuwait and rates went up 0.75% in 2 days, I remember telling people I would float right now because it was obvious that things were going to settle down a little bit after that happened. But those are unusual circumstances,
right? Right.
Thankfully. So I'd say in most cases, it's a pretty good idea to know what you're going to get, especially when you've got some downward potential. So that's that's about the closest you can get to having your cake and eat it too. Really?
Yeah.
The other way, you have no protection at all.
Got it.
Okay.
You're just taking risk, pure risk.
Right. All right. So, Pete, what do you tell your clients? Is there anything else besides the pre-approval letter? What other important things do our clients need to think about when they put together an offer with a pre-approval letter?
Well, I'm looking at what should be on that pre-approval letter. In other words, if I'm representing the seller and I receive an offer, usually I get a pre-approval letter with the offer. That's pretty standard protocol, at least in our marketplace. So what I'm looking for, we talked earlier today about what are the telltale signs in a pre-approval letter that it's really a pre-qualification and not a pre-approval. So I'm looking for things that you mentioned. I'm looking for things that have been verified: income, assets, employment, credit, source of down payment. Those are some of the key things I want to see in writing in that letter. If it says that it has a date, an expiration date, that's usually a good sign. Not all of them do, and they're still pre-approval letters. Some do, some don't. There's also a strategy in the pre-approval letter. Let me say this. A common practice with a pre-approval letter is that the offer comes in at $500 and the borrower needs $400. So the offer letter or the pre-approval letter says, they're good to buy a house to $500,000 and borrow $400,000. And so that's in there. Well, that's all well and good. I want to know that as a listing agent representing the seller. But what happens if there's another offer on the table and it's $520,000? But we like this offer, the way this offer is structured, better than the one at $520. We want to focus on that buyer. Well, I have no idea if the borrower is good enough to go to that price point. So sometimes it's better to leave the price off the letter and just focus on the maximum loan amount that the borrower is qualified to borrow. So in other words, let's say that you have somebody that's very conservative and they can borrow up to $700,000, but they only need $400,000. Wouldn't it be great to have that letter say you can borrow up to $700,000 to buy a house and just leave the price off? Because really, if you've got the down payment, everything's been verified. What that tells me as a seller that we're dealing with somebody that's not stretching to buy the house, that they're actually overqualified to buy the home. And the pre-approval letter, in my opinion, should be something that builds confidence with the seller and the listing agent that if you accept this offer, the odds of it falling apart over my ability to obtain financing are zero, essentially.
Right.
Yeah. So that would be a good strategy.
Can I just add one thing
into
it? The only thing that to be careful with, because I agree with that strategy, but there are some lending institutions, primarily banks, that require the purchase price to be put on there.
Right.
So then you can't get around it. But then maybe the best solution is at least just then tell me the maximum they can go to.
Right.
Even if it's higher than what I'm offering, because then at least you're not going to get tossed out of the pile.
Right.
Because it doesn't look like you're good enough.
Well, right. And some buyers believe, well, if I do that, then I'm tipping my hand, and the seller knows that I can pay $800,000 for their $500,000 house. And yeah, that doesn't mean that you will, though. And I've never had a buyer ever in 35 years pay more than what they were willing to pay for something. They just won't. They have their own preset maximums, and that's as high as they want to pay. If they can't get it for that price, they'll go buy another house. So I think it's more important, especially in a competitive situation, to really build confidence with the seller and their agent that you're overqualified, that you're not stretching to get this house. And it also inspires the seller to come back with a counter proposal. If they're negotiating to sell that house, then they know that if they come back at a higher price with a counter offer, that you have the ability to buy that house at that higher price. Without that, all they know is what you can buy based on the original offer.
Okay. So one last question on offers. Pete, how do you structure your client's offer to be more competitive in a hot seller's market? What are some things that you advise buyers to consider?
Well, I recommend that you verify and provide verification of the source of your down payment. So along with the offer and the pre-approval letter, it's best practice to bring with you and attach proof of down payment. Where is the money coming from? You say you have $100,000 to put down, but show me the money, basically, because I want to know as a seller and a listing agent, do you need to sell anything to get to the $100,000, like another house or a boat or whatever it is, liquidate stock? Or is part of that money coming from a gift from a relative? I want to know that too, because it's not that gifts are a negative, but you need to have confirmation that the grantor of the gift is actually going to do that, right? Mm-hmm. So there's something called a gift letter. Bob, why don't you tell us about how gift letters work?
Yeah, that gift letter, although every once in a while you'll see people maybe handwrite or type out the intent of the giftor. Let's say it's your grandmother that's willing to give some money towards the purchase of the house, and they have the way they want to write it out and say what their intentions are. Well, lenders have requirements for what the letter needs to state, and so because of that, they generally have their own template put together. That where you can just use that template, send it on to that giftor. And this, what's in the general template, it's basically you're stating that you intend to have this, be a gift. It does not need to be repaid. It's not a loan. That it's to be used for the purchase of a house. It doesn't have to specifically say, the address of that particular house, because that can change, of course. But the basics are that it's not a loan and that it's to be used towards a house. And then you list the account number that the account that it's going to come out of. And then that matches up with, Pete, what you were referring to, which is if you show a copy of the statement, that giftor needs to also show proof to a lender that they have the ability to give that gift. So you could use even page 1, let's say, of a statement that says that they're going to give you $50,000. They've got at least $50,000 in that account, and then you just want to make sure that the money does come from that account, right, when it comes time.
Yeah, because essentially the gift is a third wheel to the transaction. Without the gift, there's a gap and you can't close the sale. Mm-hmm. So it's a great thing to have somebody say to you, yeah, I'll give you the money once you find the house. But the listing agent and the seller wants to know that that is actually cast in stone, that it's a sure bet, not just a maybe. Mm-hmm. So verification of down payment in the form of copies of bank statements, and they should be current, like in the last 30 days. And you can redact account numbers for privacy and that type of thing, but at least give some idea about where the money's coming from. Once in a while, I'll get an offer that says it's not contingent on selling another home, and there's no verification of down payment with the offer. And so when you start asking questions, well, where's the money coming from? Well, we've got this house that we need to sell, and once it closes, we'll have the $100,000. So even though there's no contingency in the offer, that doesn't mean it isn't contingent upon that house selling, because it really is. It's a de facto contingency, and if that house doesn't sell and close, there's no money to close this one. So that's one of the reasons why attaching that to your offer is really critical. The other thing that's important, especially in a competing hot market for sellers markets, is to have short time frames for contingencies. And the 3 big contingencies in most purchase offers are inspection contingencies, financing contingency, and usually related to that is an appraisal contingency. So in this current environment with processing loans and getting things approved, what would you say is an average time frame that's very doable for a loan approval contingency?
Well, I would, if they've been fully underwritten ahead of time, which is that point I was kind of getting to earlier, which is that, if you just get pre-qualified, then you really should ask for more time than this.
Right.
But if you're fully underwritten and really pre-approved, those time frames have gotten a little longer lately, I would say, with the demands of our marketplace lately. It's kind of like we had a little bit of a delayed spring almost, it felt like, right?
Right.
Obviously, shelter in place and other things that kind of pushed back the beginning of the market. People couldn't even really see homes for a while. Couldn't show things the way we were used to. And once that really got started, now we're almost really at a kind of almost a peak lending environment right now. So I would say a safe number really should be 17 days. When you're competing, there are ways to try to get that done shorter, like say maybe in 12 to 14 days.
Okay.
But I would say most lenders, you want to kind of count on 17 days because that's going to include needing, the appraisal and the other steps taken care of as well.
Right. So that's kind of the minimum time frame to realistically go through underwriting. It gets back to the benefit of being pre-approved versus pre-qualified. When it comes time to write the offer, if you've covered all that ground up front, you can have shorter time frames. Having shorter time frames makes your offer more attractive to the seller, makes you more competitive. It increases your odds of getting your offer accepted. What about eliminating the loan contingency altogether and having a buyer be confident in their ability to do that and know that they can get that loan even without the contingency of loan approval?
Yeah. Well, certainly it is, can be a very big selling point at that point for a seller to, look at a situation and say, okay, they're going to borrow money, but they're not making this contract contingent on obtaining that. That shows a lot of confidence, right? That not only they've been underwritten, but they know they can obtain this financing.
They're putting their deposit at risk if they don't get the loan.
Exactly.
Right.
Exactly. There's definitely a risk for them not to have that happen. So another reason it's important to be fully underwritten ahead of time. And fully underwritten really means all your financial data, credit history, and everything has been looked at. If you get pre-approved, and more than 60 or 90 days go by before then you really want to have that redone again to make sure everything's updated. I'd say the only risks that you just want to be cautious with, make sure and ask the lender, things like, have any guidelines changed or any changes in rules since we got pre-approved, let's say 60 days ago or 6 months ago or what have you. And then it really kind of comes down to confidence in yourself, because the lender can say you're fully approved, but if you don't still have your job, when it comes time to close, it's going to be pretty tough to get that financing.
Yeah.
If you switched jobs and you did something really different, that could be something that could have an impact.
Or go out and buy some big ticket item in the middle of the escrow, right? A new car, a boat, whatever it is.
Exactly.
Right.
New debt. So, and you can see built into this it's really important to have a lot of trust and communication in the process. If I were to go out and, and do this, if I'm going to co-sign for my brother and on a loan, I'm not making the payments. What does it matter? Actually, it does matter. So it's really good to talk to your loan officer about, what you're thinking about, what's possible. A lot of times when people get excited about their house, they start thinking about getting cabinets or window treatments or furniture, and they don't, even though it's maybe zero interest to buy something, they don't think it affects them. It actually does. So It's good to communicate that, get some counsel on whether that's advisable, or not, to think about that. But I'd say in general, the main thing to realize when you're waiving your contingencies, yourself saying, I'm going to not have that requirement on a contract, you're just putting a lot of confidence in the fact that your down payment monies are going to be there when you're going to close, and you're still going to be gainfully employed. And as long as you feel real comfortable with those, then I don't think it's a huge risk to take.
And you've been completely pre-approved as opposed to pre-qualified.
Correct.
Because pre-qualified means that there's all kinds of surprises that might come up in the process that you haven't gone through yet. Whereas pre-approval, you've basically covered all that ground and those surprises aren't there to be enjoyed or discovered. Right?
Yeah, absolutely.
Right. Okay.
I'm going to add one point, just as long as we're, just having a dialogue about this, that when you asked earlier, Leslie, because I'm going to circle back to that, reasons why people's loans get denied, not too far down the list that ties into verifying things ahead of time are what lenders call reserves, which is the amount of money that you need to have left over after you've paid your down payment and your payment. So kind of makes sense a little bit, right? I think most of us like to think that when we buy anything, we still have maybe a month or two left
Right.
over, just in case anything, unanticipated happens. Well, for certain price ranges, you can need as much as 12 months worth of your payments on the mortgage and the taxes and everything else separate. And
Right.
it can be a retirement account, 401k account, certainly any kind of a liquid account that's non-retirement can be used too. But it's important to know what those requirements are too ahead of time, and take that into account. So, for instance, you've got a 401k and you feel like you're fine with reserves, but it's really close, and the stock market drops 10 or 15%. That might change your lending capabilities. So, just again, another reason why it's important to get fully underwritten ahead of time and then communicate changes to your loan officer.
Good point. That's great.
Okay. Let's talk a little bit about different types of loans that are out there. Conventional versus FHA and VA home loans. Bob, can you talk about the differences between these loans?
Yeah, sure. Okay, so let's start with conventional, that term conventional first. That is the term used to describe loans that fit into the category of the two bigger institutions in the country that were originally chartered way back in the 1950s to kind of help provide liquidity to the marketplace, help basically allow for people to put smaller down payments down, for example, for interest rates to get a little bit better. So people may be familiar with the terms Fannie Mae or Freddie Mac used. Fannie Mae stands for the Federal National Mortgage Association. Freddie Mac stands for the Federal Home Loan Mortgage Corporation. And both essentially are quasi-government entities that more or less back and insure these mortgages. In our area, that happens to be anything up to $510,000 for one level, and then there's an augment to that called the high balance level up to $765,000. Again, in the 5 main Bay Area counties. Outside, if you get outside, to a place like Benicia or to Tracy or to Petaluma or Santa Rosa, it can be very different. So you want to be cautious and know those limits. But say that generally in our area, $765,000 or less, that's considered a conventional loan.
And that's here in the San Francisco Bay Area, one of the highest cost real estate markets in the country. We have some listeners that are in Iowa, as an example. So those limits are going to be where would they?
It almost certainly the national level for Fannie Mae and Freddie Mac is $510,000. That's consistent for every state in the country.
Okay, all right. But high cost markets like these coastal markets, as an example, they're allowed to go higher because the value of real estate is so much higher.
Correct.
Yeah. Okay.
Then that category, yes. So FHA stands for Federal Housing Authority. That program was put into place essentially to allow to be a first-time homebuyer type program. It's actually not exclude. You can be a second-time homebuyer and still get an FHA loan, but the main advantages to FHA are the ability to put the smallest down payment possible, 3.5% nationwide, up to $510,000. You also have a few other things that are more helpful, flexible. You can get a gift from a friend actually and still get an FHA loan. You can't do that with a conventional loan. But you're still required to pay mortgage insurance, private mortgage insurance, which is the premium paid to the lenders for putting less than 20% down for the additional risk being taken on the loan. So FHA has a little bit higher private mortgage insurance number, and those are all factored into your qualifications. So that payment, whatever that payment's going to be on that mortgage insurance premium, those lenders are using that to figure out how much you can afford.
And then there's the VA.
And then
loan.
VA is a specific benefit for veterans. Probably the most advantageous program for veterans that have what are called the proper entitlement. Usually it means you had to have served for a certain minimum period of time with an honorable discharge, or if you've been disabled, then there's even some more advantage. But essentially, again, same limits nationwide, $510,000. You can actually finance 100% as a veteran. Put zero down.
Now, in the Bay Area, can they go higher than the 510?
They can. And then there's a up to $765,000 is you can finance 100%. As you go above that, there's a formula they use, which is still better than conventional loans. Mm-hmm. So let's say you buy $1 million house, you're probably going to have to put about 6 or 7% down instead of 0. But it's not as advantageous as 0 down, but a lot better than getting a conventional loan.
Right.
Okay.
Right. So, Pete, is it true that a buyer making an offer with a FHA or VA loan is handicapped compared to a buyer with a conventional loan? Does it make a difference for when they're out making offers?
It can. It depends on the marketplace. There are markets throughout our country where VA loans and FHA loans are common. And in that case, you're not handicapped because it's the norm. There's as many of those loans made in those markets as conventional loans in many cases. There are military towns that do a lot of VA financing because of the military folks that are buying homes in those areas, so they're common. But in some markets, like the Bay Area, they're very uncommon. Part of it's due to the limitations because of the high cost of real estate here. The maximums for some of these loans exceed or don't go high enough to be able to buy. But the problem with FHA and VA loans can be that not only does the borrower have to qualify for the loan, but in some cases there are conditions about the property that might preclude the loan from being approved, right? And I know that those have relaxed somewhat over the years recently. They used to be far more stringent than they are now, but they're still there. So FHA has some examples of that where things like peeling paint on the outside of the house could be a disqualifier. And unless this is changed, the appraiser that goes out to do the appraisal report has an overlay for these loans. And it's like a checklist that they have to fill out for an FHA loan to see if the property condition is aligned with their underwriting guidelines. So peeling paint, health and safety issues, broken hand railing, lifted concrete patios, things like that, wiring that's exposed. All of those things are going to be noted on the report, whereas in some cases, conventional appraisal reports won't note those things and they're not factored in as a requirement by the underwriter. Structural defects is another one that could be a problem with any loan, conventional or FHA, but certainly FHA and VA loans. So being handicapped means that in some cases you can get the loan, but the bank or FHA is going to require that the seller complete the repairs prior to closing, right? Is that still true, that they won't allow the buyer to make these repairs? So what happens if you have an offer that's been accepted and it's as is? I don't know of any seller out there that doesn't want to sell their home as is so they don't have to fix anything. Everybody hopes that that's the offer that they get and the sale that they get. So now you're in the middle of a sale and the bank is telling the buyer and the seller, this is how it's going to go. If you want the money, fix the paint, fix the railing, fix the wiring. And by the way, the borrower can't do it, the buyer can't do it, the seller has to do it. So that forces both parties to have to re-engineer the sale terms, and nobody likes to do that. So that's where the handicap is created. And as a listing agent, if you have a choice between accepting an offer that's conventional or FHA or VA with these surprises that might come about, you're probably going to gravitate towards the conventional buyer because there's less uncertainty about what's going to come up during the middle of the transaction through appraisal and loan approval. So it can be harder for a buyer using FHA or VA to get their offer accepted, especially in markets where most of the loans made are conventional and listing agents don't have a grasp on the loans themselves. So because they're unfamiliar with them, they just dismiss them out of hand and guide the seller towards going a different direction.
Mm-hmm. Okay. Bob, is there anything in particular a buyer should look for in a condo complex when they're purchasing using an FHA or VA loan? Are there certain requirements for that?
There are. So specifically for FHA and VA, each of those, and they are run separately, different governmental agencies that run them. The requirement for a condominium is that they've had a advanced list that they've evaluated those associations already, to determine if they meet their requirements. So it's otherwise called an FHA approval list, let's say for FHA. VA has their same similar list. And so if you're not already on that list, if it's Greenwood condominiums, in a certain town, and it's not on that list, you can't obtain an FHA or a VA loan for that. It doesn't mean that you can't be added to the list, but it usually means there's quite a bit of work involved, and that is probably not going to be a real short close of escrow.
So that's called a spot approval. Is that what you're talking about?
It is.
So if it's not already on the approved list, then you can get a kind of a one-off or spot approval is what they're commonly known as.
Is what they're commonly known, and they require the complete cooperation of the homeowners association.
That's an oxymoron.
Say not easy to do,
No.
and I think sellers know that too.
Okay.
So probably want to be a little careful, right? Like thinking I can always obtain a spot approval, because you don't know if you're going to really be getting all the help that you need to obtain that. But it is doable, and in markets where longer closes of escrow are more normal, or customary, maybe not as hard to get it done.
Or a softer market where that's the only buyer. And so you're going to work with that buyer to get that deal done because that's the only buyer out there.
Yeah.
Right. So What about mortgage insurance? And when does it apply?
Okay. So almost across the board, it's when the buyer is putting less than 20% down.
So whether it's conventional, FHA,
whether it's conventional,
or VA.
FHA or VA.
Okay.
FHA is different in the sense that regardless of the down payment, you have to have mortgage insurance. So everybody pays into the pool.
Okay.
So there's a specific reason then, if you are putting 20% down, you're going to almost never get an FHA loan unless you have other requirements. What are some of those? Lower credit scores. FHA, even though they've raised it a little bit, you could probably go as low as about 580 or 600 in credit score.
So they're more forgiving.
More forgiving.
Okay.
More flexible. VA, similar. A little bit more flexibility there. VA does not have a monthly private mortgage insurance. They have what's called a funding fee. It's a one-time fee that's paid that can range anywhere from 1.5% up to 3.25%. And you can finance it. It can be built into the loan.
Okay.
It's generally determined based on length of service and whether you had a disability or not as a veteran.
Okay. So what we're talking about is an insurance policy for the benefit of the lender making the loan. And they're insuring what? The portion of the loan that is above the loan amount? Is that how it works?
It's essentially all those premiums go into a pool, for lack of a better way to more detailed way to describe it. And that pool, so if 100 loans are done, in any market around the country, statistically, 3 or 4% of those people are not going to be able to make their payments within a year or 2 years. So what happens when that happens? The lenders have to take those back, foreclose on them perhaps, or at least take losses potentially on them because they're not receiving the payments. And so those losses are offset by the premiums that come in from the mortgage insurance.
Okay. So mortgage insurance is not necessarily a bad thing. It could make the difference of you getting the loan at all. Or it enables you to put down less than 20%, and the trade-off is your monthly payment is slightly higher to cover the monthly mortgage insurance premium, right?
Correct.
Or the funding fee if you've built that into the finance.
Correct. And if there is, we guess you kind of look at it from the opposite perspective, which is, if you go back 35 or 40 years, other than VA loans, you really didn't have much of a capability to put less than 20% down.
Right.
So enter now new instruments called mortgage insurance contracts. It enabled people to, so it really made the housing market a lot more liquid,
right.
Bringing in this whole new pool of people that can suddenly buy, and especially in more expensive markets where it's not easy to come up with 20%.
Kind of like the old pay option arms you did. Right?
Yeah.
It brought more people into the market that probably never should have been there. But
we'll save that for another podcast.
Yeah. Well, before we leave the adjustable rate mortgage thing, are fixed rate loans predominantly, most of the loans being made right now, are adjustable? Is anybody getting an adjustable rate loan anymore?
I would say pretty close to 90% are getting fixed rate mortgages, either 30 or 15 year.
Okay.
right now.
Right.
There are several things that have impacted that. The regulatory side, when the Dodd-Frank Act was passed, it made it a little more punitive. In other words, lenders can, it's going to cost them more in different ways if they're going to offer adjustable rate mortgages to borrowers. That combined with the fact that that rates for all these treasury securities, which I think we'll get into a little bit, have come down so low in all categories that there's not as much of an incentive to get an adjustable rate mortgage right now.
Doesn't make much sense for the borrower, and it's tougher on the bank, right?
If you went back, maybe say 10 years when fixed rate mortgages were 6%, let's say, for a 30-year fixed, you might have been able to get a 4.25% rate for something that was fixed for 7 years. Thought, wow, so for some people that was a big enough incentive because I might not be here anyway.
Yeah, short-term hold, right?
I'll save the
People that
money.
get transferred a lot, that's a good plan.
Today, that difference might only be 0.25%. In fact, it's pretty close to that. So then people say, well, gee, if I'm going to only save $80 a month, why should I take the risk?
Yeah. Interesting. Okay.
Let's talk a little bit about mortgage interest rates. Bob, how are home loan interest rates affected by the bond market?
Well, I think mainly the bond market, there's essentially two different sides to the debt marketplace, as we call it, that have an impact on mortgage rates. One of them is the Treasury securities marketplace, or otherwise known as the bond market, as we call it broadly, and that's essentially all the different lengths of contracts that the government offers to raise money to help fund all these great things that we spend money on in this country, right? From roads to schools and beyond, military and everything else. So those range from anywhere from a low of 30-day Treasury securities all the way up to 30-year securities. And then a lot of increments in between. The main, what we call the benchmark Treasury security that's used that mortgage rates reflect the closest to is called the 10-year Treasury. Traditionally, rates could be really close in percentage to where the rates are on the 10-year Treasury. Well, guess where the 10-year Treasury is today? 0.65%, I believe, is what it closed at today. Pretty close to historic low. Mortgage rates are not 0.65%, as we all know. So there's been kind of a disconnect, really, with the bond market that's occurred in the last year, mostly, and mortgage interest rates. So what's a more accurate indicator than now? Primarily, it's that second debt market that I'm referring to, which is called the MBS marketplace, or mortgage-backed securities. Mm-hmm. That's a pool. The Federal Reserve has nothing to do with it. Primarily, it is a private securities marketplace, just like the New York Stock Exchange or the Chicago Board of Mercantile is, or NASDAQ or any others. And people buy and sell pools of mortgages on a day-to-day basis, depending on who buy those. Pension funds.
So the bank will initiate the loan, and then they'll sell it. They'll put it in this package, this pool, and it's sold on the secondary market to investors. And then the lender, the bank retains the rights to service the loan. Is that typically how it goes?
Typical.
So they make money off of the servicing fees, right?
Correct.
But they don't want to hold those loans in their portfolio, because then they have regulations to follow with reserves with the bank, and the bank requires that they have a certain amount of liquidity to stay in the business of being a bank, right?
Yeah. You know a lot about this, Pete. That's good. Essentially, think of it really as the security marketplace, the mortgage-backed security marketplace. It adds liquidity. It enables lenders to, when they fund a mortgage, since they don't have to hold on to it now, and they can sell it into a pool, it means they can lend it now to another person. Because otherwise, if you don't do that, you can get to a point where lenders will say, we're out of money this week, or we're out of money this month, or whatever. We can't lend anymore.
Right.
And so obviously none of our real estate markets want that. So you've got this marketplace now that buys and sells these mortgages, as you say, and so lenders, of course, when they know, they're going to gauge what they charge for an interest rate based on what they think they can sell it for.
But this all ties into underwriting guidelines too, does it not? I mean, isn't there like a standardized playbook for underwriting guidelines so that these loans are actually saleable in the secondary market?
Yes. Yes. And the term that I used for those institutions that back mortgages in the country, Fannie Mae and Freddie Mac, that set the limits, they also set the rules that the loans need to look like that are inside those limits.
So all of this ties together. Standardized underwriting guidelines across the board pretty much with conventional financing, FHA, VA, because the goal is to resell them to the secondary market and make sure that those loans qualify.
Yeah, and if you're somebody thinking about buying, at the end of the day, it behooves all of us to have big companies or big pension funds or whoever wanting to buy these mortgages, because it actually makes our interest rates better.
Yeah.
In redoing that, because it's a more liquid investment. It's not necessarily in the old days, it was a bank or a savings and loan that says, I'm going to offer you 6.5% for 30 years because they knew that's what they were going to get from the borrower for 30 years was that return, and they were going to hang on to it all that time. And it is no longer like that.
Right. Okay.
Okay. So, Bob, our interest rates are really at an all-time historic low. Do you see any change to this trend in the foreseeable future? This is a question we obviously get a lot, which I'm sure you do too.
Crystal ball.
Yes. Yes. And it'll be fun to have a podcast in 6 months to see how close I was. Huh?
Right.
The outlook right now is probably more predictable than it usually is. And what do I mean by that? So rates are low. We're at, I think for recorded history of financing instruments, we're the average 30-year conforming with somebody with a good sized down payment and good credit scores and all those things we talked about earlier should be able to get sub 3%, 2.8, 2.9, and even better depending on other factors like paying points and things we talked about. But let's just say for practical purposes, you use 3% right now. For a 30-year fixed mortgage. The outlook for that right now, I would say, is likely to stay somewhat close to that range. And when I say somewhat, I'll add why I don't think there could definitely be some variation there, but somewhat close to this. Why is that predictable? For probably two main reasons. One, that the growth level in the economy was definitely affected by this pandemic. It's been more resilient, maybe people would argue, than people thought. Stock market certainly is pretty healthy right now, especially if you own about 5 or 6 stocks.
Isn't it amazing what a few $1 trillion will do for the economy to stay buoyant? It's funny how that works.
Yeah. I thought I almost shook my head today when I heard somebody tell me that the difference in what Amazon stock price did in a 3-hour time span this morning was more than the entire value of Goldman Sachs as a company.
Wow.
Just in 3 hours.
That's amazing.
But so now you've got a scenario where the outlook for economic growth is although it's optimistic, in general. I mean, there's no longer this, like, I think, real strong fear that we might have had 6 months ago that we could enter a real serious recession or depression. That could change, but right now the view is shifted a little bit more to more modest growth, but with a low inflationary environment. And the Federal Reserve has commented several times on how committed they are to actually keeping shorter-term interest rates real low. And now they're projecting, as you probably heard, all the way out to 2024, I believe.
Wow.
It was just 22. Now it's 24. Well, that's going to help keep rates somewhat in a lower range. And then the other one is the Federal Reserve is actually that marketplace we talked about, that mortgage-backed security marketplace. The Federal Reserve is actually, as part of all the stimulus plans, is actually allocating a certain amount of money and buying those mortgage-backed securities to keep the prices a little more stable. So you could call it a little manipulation or whatever, but it's an intentional strategy to kind of keep rates at an affordable level for consumers. And so I think that really, those two things are going to keep rates probably within a somewhat modest range. What's a modest range? 0.5%, 0.75% or less, maybe even for a couple of years, right now. Mm-hmm. The only trade-off to that would be probably, got an election coming up here soon. Don't know what's going to happen with that, obviously. That could affect investors' appetite for mortgage-backed securities, stocks, and then that could cause some shift in rates. And then the second one, which may even have a bigger impact, and that's when we get some vaccines. Because if, let's say, 6 months from now or 8 months from now, we get to a point where, 2 or 3 companies have had some successful trials, I guess everybody's kind of hoping for that. Who knows exactly what's going to happen, but let's say we'd be optimistic for a moment and say we get 2 or 3 companies that have had successful trials. The markets are going to shift to thinking, we're better off than we thought we were now. So I think you will, as a result of that, you'll probably see mortgage rates shift up a little bit. How much? Not 1%, but it wouldn't be hard to get back to where we were in March, and rates have come down about 0.75% since March.
So you definitely want to get a pre-vaccine interest rate locked in. That would be...
Yeah, that could be a good new product term for some of these lenders, pre-vac.
So with these current crazy low interest rates, there must be a high volume of loan refinancing that you are dealing with. How is that impacting home purchase loans? I mean, we've talked a little bit about how busy you are and the timing. These timelines are what they are because of the volume that you're dealing with. But what else?
Yeah,
does it impact?
I've never seen. I mentioned earlier, I've seen I think 6 distinct interest rate cycles. Clearly, rates have never been this low because we're at like a 50. Actually, I think we're at a closer to 60-year low right now. So that's obviously encouraged a lot of people to refinance existing mortgages if they can qualify for that and it makes sense for them. In a lot of cases, it is. I think statistically, over 30% of all American mortgages are either have been or are being refinanced as we speak right now this year. That's a pretty big number. The most the lending industry has ever done in a year, I think, is a little over $2 trillion. Just to give you an example, 2.1, 2.2 trillion. We had already crossed that record in June.
Wow.
So this could even be close to double the number the industry's ever done. So what does that translate to? That means lenders are really not quite able to handle the load. There was an executive of a company that I used to work for that said this is really kind of the equivalent of trying to get the St. Bernard in through the cat door right now. I mean, it's so. What does that really mean? It means what the process that normally for pre-approval, even let's say, that you might have been able to do in 2 days or 3 days before is probably going to take a solid 2 weeks. And with some banks, it can take 3 to 4 weeks.
So you definitely want to get an early start before you actively get out there and start house hunting and doing all that fun stuff. You need to get an early start on your loan pre-approval for what you just said.
Highly advisable.
Yeah, because, we've run into some clients recently where they're out looking at homes, they're excited, they've got a down payment saved up. Somebody told them they're pre-approved, then we discover they're really pre-qualified, but they want to buy that house like right now, and so they just want that pre-approval. They want that to morph from pre-qual to pre-approval like that, and that's just not doable.
And maybe in some cases, there are some companies that can move faster than others, and maybe get a legitimate pre-approval in maybe 2 or 3 or 4 business days. I would say that's not even close to the norm. And so even for our company, which I do believe, selfishly speaking, does move quickly compared to the competition, we still are trying to count on a solid 5 to 6 business days at least to get a full pre-approval done. And whereas if a year ago, I could probably do that in 24 hours.
Right. I remember that. That's a huge difference.
And by the way, that's another. So it should be the flag. So if you've got institutions that are saying, "Oh, there's no doubt we can get this for you in 24 hours," it probably means it's a pre-qualification,
and
not a pre-approval.
Another clue. That's a good one.
Yeah,
that makes sense. Yeah. So not only loan processing, underwriting timeframes are impacted by all of this, but other things too, like appraisals, getting those done.
Correct.
Right. How about funding at the end?
Yeah, that I would say that might not be as significantly impacted, that funding side as appraisal, but there's still, I would say everything's just a little step behind. Underwriting itself, the actual time it takes from the point at which your loan's kind of all packaged together to the point at which somebody says you're fully approved, formally approved, as we say, that's probably a good solid double to triple what it was 6 months ago.
So just kind of to recap, realistically, having a 30-day time frame from the point of your offer being accepted to close of escrow, that's realistic. That's doable. 21 days is probably overly optimistic based on where things are right now.
I would tend to agree with that.
Okay. And then on loan contingencies and appraisal contingencies, if you choose to incorporate those into your offer, realistically, 2 weeks is aggressive. 3 weeks is really more realistic, right?
I think that's a good gauge right there.
So
Yeah.
the challenge is when you're in a seller's market, sellers want really short time frames on everything. If you're going to have contingencies, they want them to be short. And that's kind of setting everybody up to fail, because that might be what they want. But when you say, okay, well, then let's make it 10, and then you get into the middle of the transaction and the lender's saying, we need more time. So you're back to where you were anyway with extensions, so why not just come out of the gate and craft the offer with realistic timeframes? And that gets back to being fully pre-approved. Maybe you don't even need that contingency because you're so strong and you've done all of your upfront work properly. So you don't even have to worry about that time frame. You're not even going to make that a contingency, right? So the only other one would be your appraisal contingency. And that's not a requirement. There's no law that requires a buyer to have any contingencies in the offer. Now, it may not be prudent to eliminate them based on the market and circumstances and all those things, but you don't have to have them.
Right.
So you can elect not to have an appraisal contingency. You just have to be prepared that if it doesn't appraise for the agreed upon purchase price, who is going to close that gap?
Right.
You have to have the will to do it and the resources, the added down payment, right?
Right. There's always that possibility that depending on if an appraisal, let's say, comes in lower than the anticipated, than the purchase price, that it could be appealed through the lender and possibly changed back, especially if somebody thinks a real flawed report has been done and that appraiser maybe didn't really know that neighborhood or that area sufficiently. But I'd say statistically, probably maybe not much more than probably 10 or 15% end up getting modified.
Right. That's been my experience. The odds are pretty low. What about appraisals? So there was a time where when we're back before the financial crisis, that appraisals were almost not even required in some cases. I guess I could say that.
Yeah.
Or they would do what's known as a drive-by appraisal, which means they drove by, they saw that there was actually a building on the lot, and then they kept on driving. And so where are we with appraisal standards and guidelines now? Have they been relaxing those over time recently? Or?
Probably two distinct swings, I would say. The Dodd-Frank Act was passed in 2011. Then there were some subsequent changes in the laws over the next couple of years after that made things get a lot tighter in the appraisal area and as well as other areas. But specifically for appraisals, you've seen them, get to the point where, in not excluding the fact that institutions can no longer just, make an order directly with an appraisal firm. They have to go through an intermediary company called an appraisal management company. And then that appraisal management picks blindly who the appraiser is that comes in. So that was an attempt to try to eliminate any quote unquote undue influence on the appraiser's opinion, of the value. Which was hard because I usually did a pretty good job of finding out the favorite wine, that my appraiser had. No, I'm kidding. But
I used to leave a new Corvette in the driveway with the keys on the hood, and I'd just kind of stand back and see if they actually figured out what that meant. Just teasing.
Human nature, right? But
yeah.
So that came full swing, and then comes the pandemic. And now, partly because of restrictions, where let's say appraisers weren't even allowed to go inside for the first 2 or 3 months. They were restricted from even going, inside the house. So now will lenders allow an evaluation of a house when you can't even see the inside? How do you even know there's a kitchen in there or the walls are not ripped apart or, that there is 4 bedrooms and not 2 or whatever? That became a very sticky topic there for a couple of months. And then the government got involved a little bit more. Institutions started loosening up a little bit more. And so now you're probably seeing a higher degree of tolerance for what we'd call drive-by appraisals, which at least now means you got to take pictures of the exterior. They may require that they at least walk in the backyard and take some pictures from the side and the back too. So that allows for a little bit more flexibility. That's not every institution. It's not every loan, but I'd say it's a lot more common now, that category. And 2, you're also seeing for people that are putting substantial down payments down, let's say 20% or more, Fannie Mae, Freddie Mac they have a program called a PIW, or a Property Inspection Waiver. And so if you've got pretty high credit scores, putting a good down payment down, there's probably a 30% chance, maybe even as much as 50, depending on the day, that they'll grant a waiver, meaning you don't even have to have an appraisal done on the property. The lender's going to use the price of the contract itself.
And now, is that on a case-by-case basis, meaning that property, this contract, this buyer, it's not blanket, that
Correct.
waiver? Okay.
Correct. It's specific to that, to Jim Brown buying, 33 Palisades Place.
Okay.
As soon as, if anything falls apart with that transaction, then they're starting over again.
Got it. Mm-hmm.
Sometimes buyers have to, they need to sell their current home before they buy their next home. What are the underwriting guidelines to qualify for the line of credit and the purchase home loan?
Yeah,
when that happens.
Interesting topic. I'm going to give you the short version answer now, and I think that might even be a good follow-up podcast topic, because we could spend some time on that, particularly for people that like to dig in a little bit more. So a little bit more generally speaking, people, if they are going to try to qualify to buy something before they sell, they are going to need to qualify for at least 2 mortgages if they've got a current loan on their house and the taxes and the insurance payment on their existing house, in addition to the mortgage on the new house. And then if they do use a line of credit, let's say from the old house, now maybe you have 3 mortgages. That maybe people aren't familiar with a term, but there's a term called bridge financing that is an instrument that institutions, they'll lend you money to help provide the down payment for buying something else. But it's still basically a second mortgage on the house that you're selling. You still have to qualify for 3 mortgages. So not easy for everyone to do that. There are a number of different ways to try to position that to make it a little easier for people, to do it. But essentially, you really kind of want to prepare even further in advance, I think, when you're thinking about doing something like that, to educate yourself.
Mm-hmm.
Like, what can I really do if I want to try to buy first, before selling?
Right.
Okay.
So it can be done, but you have to have the income. The debt-to-income ratios have to cover all those 3 loans, right?
Right.
And then what about the reserves?
And the reserves, also good point, need to be higher, because now you have to have, in some cases, as much as 6 or 12 months of reserves for both houses, not just the one you're buying. And some people might be reacting, and I know just because I talk to borrowers, they'll say, well, why is that so restrictive? I'm going to put my house on the market, right away, and it's a hot market. It's going to sell fast. Well, in general, mortgage lending kind of assumes the glass a little bit more on the half empty side, not the half full side.
Right.
So you've got to think in terms of, what happens if the house doesn't sell?
Right.
That's the way lenders look at it.
Markets change. Yeah. By the time you close on the new home and you put this house on the market, if there's a shift and for some reason it cools off, it might take longer than you want. You might not get the price you want. Who knows? So yeah, the lender's got all the risk in that case. So
back to your reserves question.
Yeah.
It's highly advisable. Not only is it required, but it's highly advisable that you have more reserves just in case things like that happen.
Absolutely.
Right. So Pete, what are the pros and cons about the strategy of buying your next home first and then selling your current home afterwards?
Well, if you don't, and you need the equity out of the house that you own in order to buy the next house, then that forces your hand into writing an offer that has a contingency or should have a contingency to sell the home that you have. And, in a softer market, if you're not in a seller's market, that's pretty much how we sell homes. We used to sell homes that way all the time before the market imbalance with lack of supply and high demand came into play. It was very common to have an offer come in contingent upon the sale of the buyer's home. So in a seller's market, though, you're basically not even in the game. If you have to have that contingency, the odds are very low you're going to get your offer accepted or even get a response from the seller. So if you can qualify and sell your home after you buy the next one, you can eliminate the need for the sale contingency, obviously. And the pros of that is that it strengthens your position to negotiate in the seller's market. you know where you're moving to, right? You know the house that you're buying. It's not a mystery anymore. You've taken that anxiety of, well, if I let go of what I have, where am I going to go? And am I going to like it as much as I have with the house that I have now? So it provides certainty. You know where you're going, how much you're paying, when you get to move in. And then it avoids a double move, because when you're moving into the next house and then you're selling the one that you have. And so there are costs and the hassle factor associated with making that double move. If you're forced into that, where you sell first and then buy second, you might have to go into interim housing because of that. The cons of that is that it's expensive, right? I mean, unless you have all cash and you don't have to go out and get a bridge loan or a line of credit, if you have the cash, then you're deploying a lot of assets into real estate, locking it in. Now, some people will do that, right? And then they'll refinance that house after everything is done. They've sold their other house, they bought the next house, then they just put a loan, they refinance the house they just bought. Since we're talking about that, are there any minimum timeline guidelines for them to be able to do that?
Well, depending on the institution you get the loan through, I would say it's kind of common to be thinking of needing to make 6 months worth of payments on any loan that you put in place.
Okay.
Not across the board, but somewhat common. So 6 months worth of payments. And by the way, one slightly creative solution that I've done with some people ahead of time is structure a piggyback loan or a first and second on the house they're buying, so that now, if they've got a $500,000 loan and a $300,000 second, when they sell the home that's left behind, turn around and take those wages or those proceeds, pay off the second mortgage. Now they're not forced. Now they just have the payments on the smaller balance, and so it avoids the requirement to have to not only have the costs of refinancing or the restrictions of waiting 6 months, but you also don't have to worry about what interest rates might change to.
That's great. Yeah, I like that.
Idea. Great.
That solves a lot of problems.
So our final topic for this episode is the COVID pandemic that we're currently in and how it's affected the housing market and the loan and lending industry. It's a big topic, but Bob, maybe you can kind of speak to how things have changed. We currently still are in the pandemic, and like you said earlier, we don't know when that's going to end. But what are some things that how has it affected the loan industry?
So I'm thinking of maybe the top 2 or 3, because there's so many that affected. But mainly, we already commented on the changes to the appraisal process and whatever, and that's certainly been one of them relative to lending. The second one, I would say, maybe what comes top to the list is the category of employment and how to verify employment. So lenders, that if they used to just verify that somebody worked somewhere at the beginning of the process, and then that was good, and then they got their most recent paycheck stubs, that shows they're still working there. Now, some lenders have as many as 4 different steps you got to go through. You have it at the beginning, you have it at the approval, you have it when you have sign your closing documents,
right? And
then 4 days later, the day you close the loan, they got to re-verify again. They are still working there that day, that minute.
And do they look at the industry you're working in as well? And do they try to predict how that particular industry has been affected by the pandemic?
I wouldn't say.
No.
Is there any targeting of industries?
Okay.
I'd say it's a little bit more across the board. There's certainly some industries that have been affected more than others. So here's the other category that I was going to get to, where it is industry specific. Bonus history. So let's say people are qualifying, for a mortgage based on getting a salary plus a bonus from their employer that they've gotten for 5 years in a row, let's say. Well, what if suddenly you work for a theme park, or you work for StubHub, or you manage a Marriott, or all those categories of industries where clearly you've been, disproportionately affected. Well, now lenders are they're requiring those employers in most cases to put something in writing that says their bonus is still going to continue in the future. Well, a lot of those employers will not do that. So that's clearly a case where the pandemic has affected the lending industry.
Right. So what about people that are self-employed professionals like dentists, doctors, attorneys, salespeople, whatever it is? It seems to me that that there has been an impact with that as well.
Yes, for sure. And maybe there's been a number of areas where lenders are being more conservative with self-employed people. But I'd say if there was a couple across-the-board requirements, it's mainly because you're not calling to verify employment when you work for yourself.
Right.
So you're mainly looking at, in most cases, let's say somebody's, we haven't even gotten October 15th, right? So some people haven't even filed their 2019 tax return. Mm-hmm. So for a self-employed person, you might really still be going off of income that ended last December. How in the heck do you know how they've done for the last 9 months? Well, now there are ways to do it. Sometimes they'll require looking at bank statements for the last 90 days to see if they can see deposits that look kind of in line with what the tax return showed from the previous year. In some cases, they'll require a letter from their accountants stating that their business hasn't been materially impacted by the pandemic. And then still other cases, they'll actually increase the reserve requirement for self-employeds. Mm-hmm. So we've seen that. Okay. We've seen like sometimes 18 months worth of reserves needed instead of 12 when somebody's buying the home. So those are probably the three biggest areas that I've seen the pandemic affect lending.
The three being employment,
appraisal, and the category of employment. Bonus or self-employed.
I mean, we've talked a little bit about interest rates already, but that's been affected too by the pandemic.
Yeah, you could definitely make the contention that rates are a solid 0.75% to 1% better because of COVID-19.
Right. And so what are some of the lessons this pandemic has taught us about the volatility of financial market conditions affecting home loans? I mean, this is an extreme example of volatility, and we hopefully won't see it again, but maybe we will.
In the early weeks of the pandemic, in March, wasn't there a threat of a credit freeze? I mean, that seemed to me that we were really concerned that is there going to be a credit market because of that? And I think from that, I mean, the government stepped in and they did some extraordinary things that you just described earlier to make sure that things didn't freeze up. But I think as a result of that, didn't underwriting guidelines change? Didn't they become a little more conservative from all that?
They did. And in some cases, for a period of time there, maybe 30 to 60 days, some lenders would not do jumbo loans. So anything over 765, there was just a moratorium altogether. But you're right. Even earlier than that, there was, I'd say, a couple to 3 weeks of a very concerning, it reminded me a little bit of the financial crisis.
Right.
When people began to wonder, this isn't just a matter of my 401k accounts dropping. It became very possible that nations were going to stop trading currencies with each other. And if that happened, we would have had a much more severe recession, maybe even depression than we had after the financial crisis. Well, similarly, basically mortgage instruments became, without getting real technical, they became very illiquid. There almost became no place to sell certain categories of loans, and that's not good.
Yeah,
there were no buyers. And so the government stepped in and they became a buyer in the mortgage-backed security market for that very reason, to ensure liquidity, right?
They created basically kind of like interim warehouse scenarios where they basically became kind of a temporary buyer or holder of the mortgages just to hold on to them for a while until a proper buyer came along.
So then would it be fair to say that since then, from that point, that low point, that it's been like a slow thaw in terms of mortgage availability, underwriting standards, appraisal standards, slowly becoming less conservative as we move forward?
I'd say almost yes on all of those. I think in every category, maybe except for self-employeds, has gotten tighter.
So that's gotten tighter. Okay, that's an interesting distinction because, if you're self-employed, before you put yourself out there or get wrapped up in a binding agreement and have deposits on something, it makes sense that you go all the way through the approval process first to make sure that your unique situation is self-employed. You're financeable, right?
For sure.
More than ever.
And some people might think, well, gosh, why are self-employed people attacked so highly? But if you think about it statistically, a really high percentage of people that own their own small businesses are self-employed. A lot of those people got PPP loans, right? The assistance from the government. Well, those only lasted for a certain period of time. And then you had certain parameters and requirements and everything. Well, we're getting to that point now where a lot of those people have used those funds.
Mm-hmm.
Right.
Maybe not entirely, but a significant percentage of them. So now lenders are realizing, okay, what's the follow-up back to that now? Has your business bounced back sufficiently? Are you still hanging in there? They've got to look at that. And you could look at it like, gee, this is really kind of an attack, if you will, or too, punitive
Right.
to people in that category. But they're, realistically, lenders they don't want to take a house back from somebody.
Right.
So they're kind of helping you out as well as helping
Yeah.
themselves out. They don't want to put you in a situation where this house may be real attractive to you, but if you're in a situation you can't afford this 6 months from now, that's not good for you or for me.
Yeah, that's right. And so those PPP loans or the other SBA loans that are available, I forget the acronym for them, aren't they required to repay those loans? And if so, isn't that part of how they look at their debt load and their debt obligations?
They do, and we're still in that interim period.
Yeah.
I think the technical requirement was it was a very low interest rate for those loans, 1%, I believe, where they could demonstrate that they didn't lay off either any or more than 10% of their employees, and they were allowed to actually turn into a grant instead of a loan.
Right.
I've heard from people and accountants that there is a lot of uncertainty as to what counted and what didn't, and I think we're still in that stage of I don't know if a lot of people really know at this point yet if it really is. So what do lenders do when they don't know? They assume the conservative position,
Right.
which is it's going to be a debt, so they'll generally use 1% of whatever that balance is.
Okay. Good to know.
There's one other category worth bringing up too, because it's related to the pandemic, and that is people have used the term or heard the term forbearance used before.
Yeah.
So effectively, forbearance in the big scheme is just a term that states financially, at least, that either because you've decided to or the lender's allowed you to, you're not making payments on that loan right now.
It's like a pause.
Mm-hmm.
It's a pause, but you have to make those payments in the future at some point.
Correct.
Right.
Correct. So student loans, for example, were granted by the current administration of I think an automatic pause through October, I believe. So nobody's required to make student loan payments, or there's no interest that can accrue to October. But lenders are still using 1% of student loan payments because they know people have to eventually pay them back.
Okay.
So it helps the consumer, but it's still going to be factored into your qualifications.
Yeah.
Similarly with those PPP loans, that could still be used as a debt, and a forbearance in the case of a mortgage is we're over 8% of all mortgages in the United States right now are in forbearance. What that means is, those people aren't making their payments, and it's an agreement with them and the lender. So it's not like they're not recording late payments for it. But to Pete's point, they do have to be paid back. And in some cases, they've got to be paid back like over the next year.
Right.
In some cases, they're getting tacked on to the end of the loan. There's still a lot of uncertainty as to how all that shakes out. But the reason I'm bringing it up is mainly a lot of people think just because they're not getting reported as lates for being in forbearance that they're going to be fine moving forward. But the real truth is most lenders won't lend to you if you're in forbearance for the next 12 months.
Interesting.
After you're out of forbearance.
Right.
Interesting. I don't think enough people know that.
So another reason to,
another reason to
prepare ahead of time.
Prepare ahead and talk to
sure
your lender. Yeah. Well, I think that wraps it up for this episode. Any other thoughts for Bob, Pete? Any other questions? I think we went over quite a bit.
We did. We covered a lot of ground today.
Mm-hmm.
We're hoping that our listeners found value in that, and we really appreciate your time and coming here and sharing all your insider financing trade secrets with us. That's great. So with that.
Yeah, if anybody wants to find Bob Casper, it's Casper, and you are with
Cross Country Mortgage.
Cross Country Mortgage, and his phone number is 925-324-2029. You could reach out to him with any questions.
Just one thing I was going to add.
Yeah.
We've gone over a lot of information here, and I don't, sometimes I'm sitting back and I'm thinking if I've listened to a lot or all of this, my head could be spinning a little bit.
Yeah.
So I guess I want to say, if you can, one of the advantages of picking the right professional, whoever they are, could be making a lot of sense out of this. So you don't need to memorize all this.
Yes.
It's helpful to know it, but if you pick the right
Exactly.
people, they can guide and navigate
Yes.
you through all this, and you don't need to be losing sleep at night trying to figure
Exactly.
out all the answers.
Yeah, you don't have to
Exactly.
figure out what the right questions are to ask. If
Right.
you're working with a real pro, they're going to help you tailor make your situation and find the solutions for you and protect you from doing things you shouldn't and help you get the things that you want.
Exactly. Good point.
Mm.
All right. Well, thank you very much, Bob, for being here.
Thanks for having me.
This concludes our second episode. Stay tuned for the next one. Thank you. Thank you for joining us for this podcast. We hope you enjoy our real estate pro tips and strategies, and we encourage you to share our podcast with anyone you know who is looking to buy or sell a home. Be sure to like and subscribe, and if you're watching on YouTube, ring the bell next to the subscribe button so you won't miss a single episode. Thank you to our producer, Sam Lubman with Painless Podcast, for making this podcast happen. I'm Leslie Whitney with Pete Sabine, and we are the 5-Star Real Estate Team.
Join us for our next episode of Real Estate Pro Tips and Strategies. Call or text 925-297-5335 to reach us with your questions and referrals, or send an email to info@5starrealestatepro.com. Thank you.